Welcome to Taking Stock for the week ending 24th of July 2026. I'm Jason Yin, and joining me today is Charlie. Welcome, Charlie.
Thanks, Jason.
Before we begin, a friendly reminder that today's discussion is general in nature and does not consider your personal financial circumstances. Nothing that we discuss today should be taken as personal financial advice or as a recommendation to buy, hold, or sell any security. Well, Charlie, we are keeping the global market discussion brief this week because most of the action was at the company level. Oil prices moved higher as tensions around Iran and major shipping routes returned to focus. Investors were also assessing the first major US technology result and whether heavy artificial intelligence spending is beginning to generate sufficient revenue and cash flows.
Yeah, markets were pretty mixed this week. Some chip and server companies rebounded, but elevated valuations, rising capital expenditure, and new US tariff announcements remained under scrutiny. The message for investors seems that there is an attractive theme, but it might not be enough. Companies must still show that their growth is creating value.
Yeah, that's right. And that's why the focus on execution was evident across this week's Australian company updates. Let's begin with Santos, which is entering an important delivery phase after several years of heavy project spending. Production rose 3% in the June quarter as Barossa continued to ramp up and also Pikka Phase 1 commenced operations.
Full-year production guidance was narrowed following earlier commissioning delays, although the revised range remains broadly in line with expectations and cost guidance was unchanged. Santos expects second half production to be 20 to 30% above the first half as both projects move towards full capacity.
That's right. Investors now need to see that production translate into stronger cash flow. Higher oil prices may support LNG pricing, but further delays would again pressure confidence. Moving on to healthcare, PolyNovo provided an FY26 guidance update with revenue expected to reach approximately $150 million, up 16% or around 1% below consensus expectations.
Yeah, we saw operating cash flow increase to $24 million and free cash flow reached $10.4 million as expenditure on the new manufacturing facility moderated. US sales remain the key driver, while revenue from the new NovoSorb MTX product almost doubled from a relatively small base.
The key development is that PolyNovo's sales growth is beginning to translate into cash. The next challenge is obviously converting its investment in manufacturing and sales capacity into stronger margins and returns. Let's now turn over to the investment platforms where both Praemium and HUB24 reported further growth in funds under management, which has been pretty positive. Praemium ended FY26 with almost $78 billion under administration, up 21%, and this was driven by its Scope Plus service for high net wealth clients.
Yeah, quarterly inflows slowed, largely due to previously flagged advisor exits from legacy businesses. Management also expects around $9 million in annual technology savings from the Technotia acquisition.
And the company now expects to complete its platform migrations and deliver those efficiencies. Hub24, meanwhile, recorded another strong quarter of inflows and also market share gains.
New net client funds reached $4.2 billion, lifting total funds under administration to a record $164 billion. Advisor numbers increased 11%, and Hub24 led the industry for net inflows for a 10th consecutive quarter.
Yeah, that's been also pretty good. But on the other hand, the federal budget uncertainty weighed on some of those inflows, but stronger superannuation inflows provided a little bit of an offset, which has been positive. The share price was up around 5%, and this reflected Hub24's resilience relative to its peers.
Execution remains strong, although its valuation leaves little room for disappointment.
We'll finish with the miners, Charlie, where the key theme was whether stronger production could outweigh some of the rising costs, especially in terms of energy. Sandfire Resources rebounded from a weaker March quarter with copper equivalent production up 38% to 47,600 tons.
Yeah, high grades lifted output at Mothio, while Matsa benefited from improved grades and record processing rates. We'll cover Sandfire in greater detail shortly, but it was a much stronger finish to FY26.
Mm. South32 also delivered a pretty solid update and it continues to shift its portfolio towards copper, zinc, and also silver. Sierra Gorda, Cannington, and also the manganese also exceeded guidance, and quarterly sales volumes rose 15% as well.
Yeah, South32 also approved an expansion of Sierra Gorda, expected to lift copper production by around 30% from FY31. Its planned sale of aluminium, alumina, and bauxite assets to Alcoa will further increase its exposure to electrification metals.
Yeah, this isn't a sector that we increasingly like, especially given the fact that the EV ramp up has been very strong lately. The strategies are pretty clear as well, but value will obviously depend on the sales proceeds, the project costs, and also the return on investment as well. Investors voted with a bit of confidence, and the share price was up around 5% this week. And lastly, closing it off, AIC Mines also outlined a stronger production growth supported by the Jericho mine and also the expanded Eloise plant.
FY27 copper production is expected to rise by roughly one third to between 17,500 and 18,500 tons, with higher targets also set for FY28 and 29.
Yeah, however, the costs were above expectations as development spending was brought forward. Shares fell around 15 or so percent, and that showed some of the higher output. It was not really enough to cover some of the offsetting costs and also the funding burden, which has also risen.
Alkane Resources faced a similar response after completing its first full year following the Mandalay merger. Production finished near the upper end of guidance, and operating cash flow reached a record. Cash, bullion, and investments increased to $454 million. The board also proposed a maiden fully franked dividend.
Yeah, it's pretty interesting how the company had really high cash flows to support that maiden dividend. But I guess one of the key takeaways was the concerns around some of the costs, with FY26 slightly above guidance and also FY27 higher than what analysts are currently expecting as well. Share price fell around 5%. Investors weighed some of the strong cash generation against some of the higher operating and also growth expenditure expected.
That captures the broader theme there. Investors are rewarding growth where it can be delivered efficiently and converted into stronger cash flow and shareholder returns.
For Under the Microscope, we're taking a closer look at Sandfire Resources. The company has spent several years reshaping itself into a large, more diversified copper producer, but that transformation has required substantial investment and placed pressure on the balance sheet. The latest quarter result provides an opportunity for us to assess whether that strategy is now beginning to deliver.
Yeah, and Sandfire operates two key copper assets, Mothio in Botswana and Matsa in Spain. In recent years, the company has focused on building Mothio, integrating Matsa, and using cash flow from both operations to strengthen its balance sheet.
And the June quarter showed that the strategy is coming together quite nicely. We've seen higher grades and also improved processing lift the production profile, while stronger cash generation allowed the company to repay its corporate debt, which has been positive.
Yeah, and higher production doesn't always create value, but it has in this case because most of this quarter's improvement has flowed to earnings, cash flow, and the balance sheet.
That's right, Charlie. Very, very good positives. But there are obviously risks that still linger. For example, the FY27 production guidance for copper was slightly below analyst expectations, and also capital expenditure is increasing, and performance remains sensitive to grades, costs, and also copper pricing as well.
Yeah, even so, Sandfire enters FY27 with two established operations and a net cash balance sheet, giving it greater flexibility to fund future growth without relying heavily on new debt or equity.
So the investment case is becoming less about whether Sandfire can build and integrate these assets and more about whether it can now operate them consistently, control costs, and also convert copper production into sustainable free cash flow. And that shift has given investors a clearer basis on which to assess the company's future returns on. And that's why we still maintain a pretty positive disposition towards the company. For question of the week, we've got the question asking, how can investors tell whether company growth is actually creating value? Well, from all the financial literature that we've read, the strongest type of growth often converts into higher cash flows, a healthier balance sheet, and also greater value per share without exposing investors to disproportionate risk. So, Charlie, starting off cash flow, can you bring us on that little journey together?
Yeah, so the most important thing in the valuation of a business is cash flow. And revenue or production may rise for a business, but shareholders will gain very little if that cash is completely consumed by capital expenditures, development costs, or working capital long term.
That's right. We all know the adage that cash is the lifeblood of any business. So if it doesn't have any cash flow, but it's got revenue, it doesn't really mean much anyway. So moving on next, we examine the balance sheet. For example, Sandfire used its cash flow to repay its debt, which has been positive. Companies that repeatedly borrow or issue shares may be creating less value than their headline growth suggests. So it's very important for investors to have a look at the leverage and see where a lot of that growth has been driven from.
Yeah, and that third test that we're going to do next is really value per share. And
Mm.
acquisitions and capital raisings can make a business larger while diluting existing shareholders. What matters is whether earnings and cash flow per share are increasing.
That's right. This is very important, and investors must compare the expected return with some of the risks. So, taking a look at another company, AIC Mines, they've outlined a stronger production but also higher costs, while Santos now needs Barossa and Pica to really justify the years of capital spending. So, investors really need to see a lot of that value creation coming in the form of value per share or EPS growth that we generally speak of.
Yeah, and this principle obviously applies outside of mining as well. PolyNovo's improving free cash flow strengthens the quality of its sales growth, while platforms such as HUB24 and Praemium create value when revenue grows faster than costs.
That's right. Growth is not simply about becoming larger. The best growth improves cash flows, strengthens the balance sheet, and also increases value per share, which is what we said before, without taking excessive risk by management.
Headline growth is only the starting point. What matters is what ultimately flows through to shareholders.
Well said, Charlie. And that brings us to the end of this week's episode of Taking Stock. Thank you so much for your insights today, Charlie.
Thanks, Jason.
And to all our members watching, if you know someone who could benefit from a conversation about their investment portfolio or from learning more about the Stock Doctor platform, we would really appreciate an introduction. They're more than welcome to contact Charlie or myself directly. Until next time, have a happy, healthy, and prosperous week ahead.